Well, let's get more on Iran now. Joining us is Australian Stanford Asset Management CIO Sterling Larkin. You know, Sterling, it's great to have you back in studio with us. You were on just in the last couple of months. And looking ahead to 2020, you were pretty optimistic and upbeat on stocks. One of the reasons was, hey, look, it's an election year. You think Trump's going to get reelected. Boom, it's going to power stocks. How has this changed, if at all, with this unexpected rise in tensions, which may not be over between the U.S. and Iran?
Good evening and Happy New Year. Exactly, as we talked about 6-7 weeks ago, the S&P 500 was in a risk-on phase, and we saw 31% on the S&P 500 here in New York. What's happened in Iran in the last few days is obviously troubling. From a political point of view, it's very deft for Trump to do that. But from a geopolitical point of view, it's just going to add more volatility. And as we're going to talk about, no doubt, over today's conversation, the cyber realm is really where the area that investors should be focusing on and where the threats are.
Many people have come on shows here in the U.S., in Asia, and pointed to history.
Yes.
That when something like this happens, a geopolitical instance, even a war, some kind of conflict, that markets react, they're volatile for a while, and then they settle down, they put it behind them and move on. Do you think that pattern will repeat itself? Is there something different in 2020?
That's a great question. And people are already calling this the roaring 2020s, which is pretty ominous for a number of reasons. Why it's particularly pertinent for Australians and people around the world is the great challenge, it's the hegemonic challenge between the US and China. That hasn't gone away. Trump's doing a great job of distracting and throwing up flares left, right and centre. But the internet is a force that's obviously important from an economic point of view, a social point of view. And Iran is a very, very active agent when it comes to cyber. And we haven't seen the start of that yet. And this is where it's concerning that you just can't quantify that and you don't know how it will affect any of us going forward.
Is tech then one of, or I suppose the realm of tech, one of the biggest risks that you're watching this year?
Absolutely. But again, Iran has developed some software that they've been warehousing now apparently for the last 10 or 15 years. And we just don't know how and where they'll deploy it. What's important to know is just to be vigilant, and that 2020 will be a year that is unprecedented by any other standards, as per the last question. From a financial and economic point of view, as we talked about last time as well, we're still in a risk-on phase, which means there's probably 10 or 15 to 20% upside in the S&P 500 here in the US. However, when there is a retracement and markets do become rational again, when that is, we'll find out in the next 2 or 3 years, then obviously redemption of capital is all important. And it's not just about making the right investments, it's about ensuring that you have systems in place, both physical but also protocols, to ensure that you obviously redeem your investments and you understand the exposures and the risks that you're taking, both from an infrastructure point of view, but obviously also an investment point of view.
So it sounds like a while yet before we'll see this, much heralded rotation into value.
Well, again, I'd love for someone to show me a mathematical equation showing what actually is value in 2020. The premise of what value is really being re-engineered at the moment. And what's concerning is we do rely on these formulas, and they have been very helpful for the last 75 years in economic history, but things are changing. And again, if you do have a cyber threat, that goes out the window and you can't mitigate if somebody wipes your hard drive or if a server overseas is compromise your data. So there is a number of real life threats that are compromising what we're doing in financial markets and obviously the real economy. But again, what we're all learning is the world is getting tougher for all of us, and we need to be vigilant and focus on the things that matter.
So what matters this year? Do you hedge? Are there certain industries, certain sectors that look good in equities? Are there certain bonds of any kind that look good? Yeah. One minute you think they're going to go to 2.5% on the 10-year yield. Yes. Next minute, you're down at 1.70 for about an hour.
So you had Mohamed El-Erian on not long ago, and he was saying, people are saying to move to EM or the emerging markets and to tilt away from the US momentum. But his position, and I agree with that, is don't exit the US yet. The momentum is still here in North America. It's still the propeller head of the global economy, still the propeller head of the financial markets. And obviously the momentum is being seen here in the US and will both in fixed income and in equities as well.
So what do you think, what's going to be the high for the S&P 500 this year?
It's a $64 million question. Again, we could potentially have another 20%. We did see 31% with distributions in last year, and there's no reason to say that we won't do this again. This very much feels like 2006, 2007. We know that there's a lot of money to be made in the markets over the next 12 months, but we know that there's a real cliff coming, 12, 18, 24 months from now. And again, what's important is being sober about that and having steady hands, but making sure you have plans now well ahead of time that when things do turn, that you're well prepared.
Sterling, stay with us. Sterling Larkin, Australian Stanfirst Asset Management CIO. Lots more to discuss in just a moment.
Still ahead, the bushfire in Australia. Economists are predicting up to a 0.4 percentage hit to GDP. We'll ask Sterling Larkin's take on that next.
Well, let's stay with the bushfires, and the crisis may hit GDP growth by as much as 0.4 percentage points. Still with us is Australian Stanfirst Asset Management CIO, Sterling Larkin. Sterling, it's difficult at this point, particularly as the crisis rage on. The insurance claims continue to come in. The damage assessment is very much a movable feast at this point. But what's kind of your gauge as to how detrimental economically it will be, taking into account of things like tourism, retail sales, and consumer confidence?
Sure. And firstly, thoughts are with everyone back home. And look, there's nothing clever to say about what's going on and what's happened with this national tragedy. From a GDP and from an economic point of view, I think it could be much higher than 0.4%. We're already seeing tourism. There are official statements from the Tourism Board of Australia and from politicians saying, please don't avoid coming to Australia from a tourist point of view. Obviously, we have international students. It's an important part of our economy. But good, Australia is now in its 30th year of economic expansion. The Reserve Bank has been manipulating and smoothing out these metrics for a long time. And if we actually now have a true recession on the basis of something that people now take more seriously, like what's been happening with bushfire, at least there's something that good will come from that. Obviously, none of us want any of those scenarios, but the fact that we're in this scenario is pretty concerning for everybody.
Yeah, Sterling, I think you're, one of the people that say, look, 30 years without a recession is not sustainable and probably not normal either. But I'm wondering, as the pressure mounts on the government and also on the opposition to come up with a cohesive energy policy that has a sustainable energy mix, if you look at a potential transition into low carbon, into renewables, if you're an investor who wants to be on the right side of history, if you will, yes, but also looking for opportunities, what's out there?
Yeah, a great question. If I could answer very quickly in two ways. Firstly, I think as a society, we need to take responsibility. Australia has this obsession with blaming bureaucracy and government for everything, and I think we need a sober look at that, and we all need to take responsibility here in North America and obviously across the world, and particularly in Australia. From an energy point of view, I think we need to have a serious national conversation about thermal, about solar, and obviously about nuclear as well. Australia has got 83% of the world's yellow cake uranium. We have been fueling nuclear power around the world for the last 30 to 50 years. And again, it's an important conversation that I think Australians need to have, and obviously will affect how we invest moving forward.
Does this change what the RBA does or doesn't do this year?
As I mentioned when we spoke 6-7 weeks ago, the RBA officially saying it won't start printing money and will go into negative interest rates. They will. There is no way that the global economy will keep moving in the way, as we've talked about today in this session, the risk on, and stay where we are without stimulating the economy. There's only one way that we keep following the US economy, and that's by printing money, whether we call that UBI or MMT. And again, that will affect the Australian government bond 10-year fixed income market in very significant ways. And when you have $3.1 trillion in forced savings being our superannuation system that relies on that AGB, the 10-year government bond, again, we need to have a very sober and important conversation about what we're doing, what we're funding in society, how we're giving back, and how we're planning for the future without manipulating numbers and telling ourselves one thing and then watching our country burn away in the meantime.
Getting back to the Reserve Bank of Australia and what they may or may not do, you're saying don't just go down the same road as the United States, but Phil Lowe, head of the Reserve Bank of Australia, who has in the past indicated resistance to quantitative easing.
Correct.
Nevertheless, there's a lot of economists in Australia and around the world who think that eventually that's where the RBA will get, because they're going to cut rates a couple times because there won't be enough physical support.
Yes.
And they'll have nothing else to do.
Yes, correct. But as per the last question, the last answer is, it's not just a central bank, it's not just the fiscal and the central part of our government that needs to do its heavy lifting. We have what's called the four-pillar policy in Australia, where the four Australian banks are protected by constitution. We just had a Royal Commission, which is a significant deal in Australia, and if the Royal Commission concluded anything, it was to repeal or bring back that four-pillar policy. It's done its purpose, and again, we're now living in an economy which is the longest expansion in human history. We have the largest expansion in in residential investments in Australia, and again, even if the Reserve Bank does cut rates or start printing money, whatever they do, the distribution on the banking and the private wealth side needs to be efficient as well. And there's clearly huge inefficiencies in that part of the market.
In terms of investments in
Yes.
this year, where are you? Where would you be in Australia? Or would you say, too much uncertainty, I'll just stay away?
We're a global ex-Australia wealth team. But Australia the ASX 200 is seeing highs. Again, the Australian dollar is hovering where it has when we had the carry trade, where we had higher interest rates in North America, and where we're exporting to China. Both those things aren't true anymore, and yet our Australian dollar is still very sticky. So from our point of view, North America looks more attractive, despite the geopolitics and all the things that are obviously concerning all of us. But Australia really has a hard case to say why you should invest in the 30th year at this price.
It's a good question. Sterling Larkin, thank you so very much for joining us. He's Australian Stanfirst Asset Management CIO.